أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على رسول الله وعلى آله وبارك وسلم. Assalamu alaikum dear students, I welcome you all once again to another session of our video lecture series for the subject of principles of auditing. Today we'll have lecture number 3 of chapter number 3. In this lecture we'll have discussion on management assertions and audit objectives. Basically, the topic of today's lecture looks like there are mainly two topics, but it's not the case. It's the same topic, but is from different perspective. Management assertions, this is from the company's perspective, the company which is under the audit. And audit objectives, this term is basically from the auditor's objective. So basically, when there is an audit process going on, there are two parties to that audit process. The first one is the management of the company or the company itself. So all the positive claims that the company has about the accounting record and financial information of the company, those positive claims are known as management assertions. Similarly, on the other hand, if you look, there is the auditor who is party to this audit process. So basically, the purpose for which the auditor is carrying out the audit process, the entire process, those purposes are known as the audit objectives. So audit objectives are basically those assertions that the management have. The purpose of the audit process is to prove those assertions are correct. The assertions or the positive claims made by the company or the management of the company. So the purpose of the auditor or the audit process is to prove those assertions to be correct. So on one hand, if we have a list of management assertions, on the other hand, that same list is basically the objectives of the auditor or the audit process. So it's a one picture but has two sides. From one side you look at it as in management assertions, and from the other side you look at it as the audit objectives. Okay, so let's go ahead and discuss further about the management assertions and audit objectives. Management assertions. Let's talk about the management assertions. Management assertions are implied or expressed representations by the management about classes of transactions and related accounts and financial statements. Earlier we mentioned that all those positive claims or positive presentations or claims made by the management of the company with regards to the accounting record and financial information of that company is regarded as the management assertions. Let's take an example. A management assertion is that the company's financial statements are prepared based on international financial reporting standards, right? The company claims, and it's a positive claim of the company, they claim that their financial statements are prepared based on the international accounting standards, which is international financial reporting standards or generally accepted accounting principles. So this is basically a claim made by the company, and that's why it's called management assertion. On the other hand, basically the purpose of the auditor or one of the objectives of the audit process or the auditor is to prove whether the accounting record and financial information of this company is prepared based on the international accounting standards, which is IFRS or GAAP. Okay, so that's the example for management assertion and audit objectives. The audit starts with financial statements prepared by the client and the claim or assertions that the clients makes about these numbers. For example, when a company prepares financial statement, the company should be responsible for all the issues related to these financial statements or the information presented on the financial statements, and definitely they will claim that these financial statements are, from material perspective, they have no issue. From the standards perspective, they have no issue. So basically, these different claims coming from the management side of the company, that becomes the management assertions. On the other hand, it's the job of the auditor to validate those assertions by looking at deeper into the accounting record and financial information of that company. So in order to do so, the auditor will identify audit objectives, which is basically to prove the management assertions, right? So the management, when auditors prove the assertions of the management, that basically becomes the audit objectives, which can be regarded as the auditor's counterpart of management assertions. All right. I hope I could explain the main concept behind the management assertions and audit objectives. Earlier mentioned that basically both, it's one picture which has two sides. From one perspective it's one thing, from the other perspective it's the other thing, but basically it's a single picture. Okay. All right, so let's continue further. There are three classes of management assertions. There are three categories, or we can say there are three groups of the management assertions. Or in other words, we can say management assertions are divided into three categories, right? The first category is assertions about the classes of transactions and events for the period under audit. So it means that management assertions about the accounting record and the primary book of accounts, which is journal, basically. So we will see what are different management assertions about the accounting record and about the book of entries, primary book of entries, book of entries of the business transactions. So all the management assertions which are related to accounting record in the book of entries or primary book of accounts, all those assertions are known as the first class or the first category of the assertions of the management, which on the other hand are basically the objectives of the audit with regards to the accounting record and book of entries or journal. Let me talk about accounting record. Accounting record is basically all the supporting document behind a single transaction whose entry is passed in the journal or in the primary book of accounts. For example, on a certain date, the company's accountant has passed a certain transaction, passed an entry for a certain transaction. So that transaction for which an entry has been passed by the accountant on the journal or on the primary book of accounts or the book of entries, there should be supporting documents. What could be supporting documents? Supporting documents could be a purchase order, it could be invoice, bills, and all the other related information which supports a transaction to happen, which supports that this transaction has actually happened. That is called accounting record. So that's why we have a set of management assertions or other objectives for this category, for this class, which is accounting record and book of entries. The second class or second category of management assertions and other objectives we have is for the ledgers and trial balance. Basically, in the ledgers and trial balance, we have account balances, which are at the end of the period. So there are certain assertions which the management of the company have about the ledger and the trial balances, or we can say the account balances which exist in the ledger and trial balance, which on the other hand are the audit objectives, which auditors are looking into it and trying to validate or find out based on those objectives that the auditor set, which are on the other hand the assertions of the management of the company, and we will discuss them one by one in upcoming slides. Assertions about the presentation and disclosure. So basically, where do we have presentation of the accounting information and disclosure of the accounting information? We disclose them in the financial statements, which is called basically the financial information, right? So accounting information is presented and disclosed in the financial statements. So all the assertions related to the financial information or financial statements or accounting information, that's a separate category, and auditor has the objective to validate those assertions. So let's see different assertions and management assertions and audit objectives for these three classes or categories of the assertions. The first category is assertions about the classes of transactions, which is basically accounting record and the book of accounts. There are 5 assertions, 5 claims, right, which basically talks about the quality of the accounting record and the book of accounts. On the other hand, these 5 are the objectives of the audit. The first one is occurrence. It means that the company claims, the company asserts that all the transactions and events which has been recorded in the primary book of accounts are supported by the accounting record and have occurred in reality, and they are pertaining to the entity. There is no transaction which is not pertaining to this entity and has been recorded in this entity's record. Means that management claims whatever has been recorded in the book of accounts, primary book of accounts, which is backed by the supporting documents, is pertaining to the entity and has occurred in actually. Number 2 is completeness. This is the second assertion or second claim, on the other hand, second objective of the auditor. Completeness means that management asserts that all the transaction in events that should have been recorded have been recorded by the accountant of the company, which means that there has been no transaction left out and no transaction extra included in the book of entries. Accuracy. Accuracy is the third assertion. Management asserts that amounts and the data relating to recorded transactions and events have been recorded appropriately. It means that management asserts that the amounts which has been recorded in the book of accounts, the entries which has been passed, the amount of those entries is basically accurate. There has been no amount, no entry overvaluated or no entry undervaluated. Cutoff. Cutoff is basically the fifth assertion, and management asserts that transactions and events have been recorded into the accounting period, which means that all the transactions, all the entries which has been passed in the book of accounts, they basically belong to the correct accounting period, means that there has been no entry included from the previous period, no entry included in the upcoming period, succeeding period. Means there has been correctly period cutoff, the revenues and expenses match, there is no revenue which is left out to the upcoming year, no revenue recorded in the previous year, the revenue which is recorded in this period belongs to this period, and similarly the expenses which has been recorded against these revenues also belong to this period. And that is the objective of the auditor as well. When auditor comes and investigates your accounts, they will look at it if there has been correctly recorded, looking at the cutoff period of that company or accounting information. Classification is the fifth one. The management asserts that all the transactions for which the entries has been passed in the book of accounts has been correctly classified into the 5 standard main accounts, which is assets, liabilities, capital, or we can say equities, expenses, and revenues, and to their sub accounts. The classification has correctly been made. So on the other hand, this is the objective of the auditor. When auditor audits your accounting record in book of accounts, he will look at it, the classification as well. All right. So these 5 are basically the assertions about the class of transactions, or we can say about the accounting record or the book of original entries. These 5 are, on the other hand, the auditor's objectives. Okay. Next class, or the second category of management assertions, is about the account balances, which is basically, we discussed earlier, the journals and the trial balance. The first assertion in this category is existence. The management claim and assert that the assets, liabilities, and equities which has been recorded in the trial balance, or which has been shown in the T accounts, really exist. All the assets which has been recorded, they do exist physically. Liabilities also do exist. Equities also do exist. And the combination of liability plus equity are equal to the assets. Rights and obligations. And before discussing rights and obligations, it's the objective of the auditor and the audit process to prove the existence of the assets, liabilities, and the equities. Rights and obligations means management assert that whatever the entity holds as an asset, as a liability, or as an receivable, or as an payable, they basically there are basically liabilities, there are basically payables, and they are accurate. Means that the asset which has been shown in the trial balance or in the book of secondary accounts or secondary book of account, which is the ledger, company asserts that the assets, the rights of holding the assets or the ownership of assets are in the management or in the company's control, and if there are any liabilities against that, they are also shown. Completeness. The management asserts that whatever has been shown, whatever the balances of assets, liabilities and equities have been shown in the record, which is basically here the ledger and the trial balance, they are complete. There is no over reporting of liabilities and assets and equities, and there is no under reporting of all these. Similarly, there is no over reporting of revenues and expenses. Valuation and allocation. Assets, liabilities and equities are included in the financial statement at the appropriate amounts. Resulting valuation or allocation adjustments are appropriately recorded. It means that management asserts that the valuation process and value allocation process has been carried out appropriately as per the accounting standards and financial reporting standards. No asset has been allocated in overvalue, and no liability has been allocated as an undervalue. No equity has been allocated as an overvalue, and similarly undervalue. Means that the allocation of the asset values, liability values and equity values, and similarly on the other rights and obligations, the valuation process is correct and according to the standards, and that's the job of the auditor, the objective of the auditor, to prove whether the company has gone through proper valuation and allocation process. Okay, next we have the third category, which is about the presentation and disclosure, and in simple words we can say about the accounting information and the financial statements. The first assertion that the management has is the occurrence in rights and obligations. It means that the management assert that they have disclosed all the events, all the transactions and all the matters which are related to the company. They have correctly, properly and according to the standards have been reported on the financial statements, and whatever has been reported and recorded on the financial statements have actually occurred, right? So in balance sheet we have 3 items, and on the profit and loss statement we have 2 items, and the other rest of the 2 statements we have cash flow statement and the change in equity statement. They basically show the increase or decrease in the equity and the increase and decrease in inflow and outflow of the cash from the organization. So whatever has been reported on those 4 financial statements have really occurred. The rights all the rights belong to the company, and the obligations are also correct. Completeness. It means that the management asserts that the financial statements show a complete information, complete with regards to the accounting record, with regards to the standards, with regards to the cutoff period, with regards to value, with regards to quality and quantity. Classification and understandability. The management asserts that all the balance sheet items, profit and loss statement items, cash flow statement items, equity statements items have been correctly and properly presented, classified, and are understandable because they are as per the international accounting and financial reporting standards. International Financial Reporting Standards, IFRS, International Accounting Standards, GAAP, Generally Accepted Accounting Principles. Accuracy and evaluation. It means that management asserts that all the items which has been recorded and reported in the financial statements as a financial information is accurate and valuation is also appropriate. So that is, on the other hand, the objective of the auditor, to prove whether the information is accurate and valuation is correct or not. So these were the management assertions, and if we prepare a list of these, a common list of these assertions, we can call them as an audit objective. So if you look at this slide, I have listed down, I have prepared a single list of all these assertions which management has under these three categories, first, second and third category. I have combined them into one list and we can call them audit objectives. They are nothing, no other than what we have already discussed. As a single list, we can call them audit objectives. So what are the objectives of the audit or the audit process? The objectives of the audit process is occurrence, completeness, accuracy, cutoff, classification, existence, rights and obligations, valuation and allocation, understandability and consistency. Means that when an audit process starts, basically the main purpose of the audit process is to achieve these 10 objectives, which means that an auditor will evaluate your accounting record and financial information based on these three objectives. In other words, it means that when auditor investigates your accounting record and financial information, he will see its occurrence, he will see its completeness, he will see its accuracy, he will validate its cutoff, he will validate the classification, the existence, the rights and obligations, valuation and allocation, understandability and consistency. Means that your a company's accounting and record and financial information will be validated based on these 10 qualities of accounting or financial information. So an auditor validates your accounting system or financial system based on these 10 objectives, right? In each process, at each step, he will validate your accounting record information based on these these 10 objectives and these 10 qualities. All right, hope you guys have understood. I think it's enough for this lecture, and I hope that I could deliver clearly and more concisely and more comprehensively, and made this lecture easy for you, made this lecture understandable for you. And I hope that you have understood what audit objectives are, what management assertions are, and basically you've understood that this is basically the same picture having two sides. All right, if you become an auditor in the future, you will evaluate and you evaluate or validate the accounting record and financial information of the companies based on these 10 essentials or objectives. And similarly, if you are a business organization, your accounting record and financial information must contain these qualities, right? So hope it's clear for you. Thank you so much for being with me. God bless you. Stay home, stay safe. Wassalamu alaikum wa rahmatullahi wa barakatuh.